Hi, everybody, and welcome back to EBNet Stream. We recently popped onto our publications podium Momentum's latest Mindfields report, summarizing some of the latest research on smart beta investing. So I thought I'd catch up with Eugene Botha, who is the head of the Research Hive at Momentum Investments, and ask him a couple of questions that came to mind when I was reading this research. Welcome to EBNet Stream, Eugene.
Thank you very much, Natalie, and thanks for having me.
You're welcome. So let's start at the beginning. I will admit that I'm a little bit out of my depth when talking about something called smart beta. Perhaps you could explain in a quick summary for those of us who need to get on board how exactly smart beta works.
Sure. So Natalie, if I can maybe take one step back and just talk a bit about the origins of smart beta and where it actually came from. So if we go back in time and look at the timelines of investing and how that has evolved. I mean, it evolved from the modern portfolio theory thinking to the CAPM approach to the early 19s, where Farmer and French actually came about and said that the market is dissected in a couple of different fundamental factors that drives the equity market, and they said it's about value predominantly and size, and you can actually harness those two factors out of the equity market to outperform that equity market over time. Right, so that's where it all started, is to say that there's a fundamental approach to equities, and if you invest in a specific way, a valuation approach, or investing into smaller companies, those should outperform the market over time, and that has evolved into the modern thinking currently, where we say that there's a lot more to that than just value and size, right? So if we think about that, then it's and how you harness those specific risk premiums. It's about a systematic and quantitative way of extracting those specific premiums out of the market. So it fits nicely in between your pure passive investing, where you try and harness and exploit just a pure index, and the far right, which is in our minds the far right and end of the spectrum, where it's pure fundamental active stock picking approaches. Maybe a bit more detail to that is, if we think about all of your fundamental active equity guys and their philosophies, what they really intend and try to do is there's specific fundamental factors that they believe in philosophically drives the market, and those fundamental factors will outperform the market over time. They just do it on an active stock picking approach. And whereas smart beta is effectively saying that you can actually do that in a systematic way consistently through time. So it's that happy middle ground between active and pure passive.
I'm still battling to understand it here. So for me, passive is, I'm just going to say, index tracking, and active is definite active decision making, choosing shares. So when you say this is the middle ground, this middle ground offers what kind of value to an investor or to a trustee looking at investments for their pension or provident funds?
So it's about mainly two things. It's systematically harnessing what active managers can do without necessarily deploying the stock picking skill that sits within the experience and history of a specific manager, but it also does that at a lower cost. So you can build a value strategy and harness that systematically by quantitatively screening, for example, all of the shares based on those fundamental factors, and building a portfolio based on those shares that depict the highest kind of attributes to certain fundamental value factors. Whereas an active fundamental manager would go one step further to say that does it make sense? Whereas there's lots of insight and stuff that you can build into that smart beta space as well, to ensure that you're doing the right thing as well. But it's really that systematic approach, the ease of exploiting that strategy at the lowest possible cost as well. So you should effectively harness the benefits from a cost perspective within those smart betas.
So what I'm hearing you say is one of the advantages of a smart beta portfolio is, as you've said earlier, the best of both worlds. You get this kind of active investment activity, for want of a better word, driving the equity selections or whatever the asset class is that you're working with, but still enjoying the kind of passive lower costs. Am I summarizing it right?
100% correct. So it's an active strategy at, enhanced passive kind of costs that it typically runs at.
Perfect. And I think the lower cost talks to one of the advantages of smart beta. But I wonder if you could perhaps touch on some of the challenges. So what makes this unique, but also possibly creates difficulties for yourselves as managers or for the trustees who are trying to evaluate these types of portfolios for the members of their funds?
But first and foremost, when smart beta is not equal to smart beta across different markets and geographies, right? So even though that we believe that fundamentally the same kind of fundamental factors drives the equity markets similarly in different markets, you have to take into account the intricacies of each specific market to understand whether it drives those risk premiums in the same kind of a way consistently and robustly through time. So there's a bit of detail in the understanding of those different fundamental factors across different markets. And therefore, our focus on the research to understand that. But if you can get that right, there's lots of value in there. For example, if you look at the South African market, talking to some of these challenges, you need to understand the nuances within a South African market where it's highly concentrated first and foremost. So we've got 125 odd shares, which at most 60 to 80 of those shares are investable and liquid. We have to understand that there's liquidity constraints to a large extent, outside, call it the top 40 shares. And we need to understand, there's a different kind of volatility that you experience in concentrated, markets that's highly driven by, macroeconomic factors, political risks within the country, as well. So these nuances and risks and difficulties in, smaller concentrated markets that you need to understand as well to apply the systematic approach to harness those smart betas in markets like South Africa. But if you can get that right, there's definitely value in extracting those through time.
So much like the debate around the trustee meeting table might be, do we keep assets local or do we take them offshore? Is it a similar debate around should we use active managers versus passive managers versus this middle ground smart beta?
To a large extent, yes. Our belief is that, from a pure philosophical and from a portfolio construction perspective, our departure point is always passive. So it's a lowest cost. You get the market, but we understand there's challenges again from a market concentration, liquidity, exposure perspective in doing purely that. As soon as you want to go the route of outperforming the market and getting away from those risks that I've just highlighted in purely just investing into passive, then smart beta is the next best answer to that. It's a low cost alternative to going the fully active. It gives you the ability to outperform the market over time. And as I've mentioned, it's lower cost. And then we do believe that there's skill in selecting the right active fundamental managers, right? So and therefore you can go further and say that which kind of an active fundamental manager would give you a similar kind of a return profile that your smart betas will give you over time, which is worth their salt and can do it on a net or fee basis. So I guess the answer is therefore it's not similar to the active passive debate, similar to the local versus offshore debate. We believe that there's space for both of them, in a portfolio and in a long-term portfolio construct. Maybe to take that one step further is that very often, especially again, for example, in a concentrated market like South Africa, where most of your active fundamental managers are very much focused on value or valuation types of strategies, it's often difficult to exploit risk premiums in a fundamental way, like a pure momentum kind of strategy or a pure quality strategy. It's often, those managers will have a mix of pure valuation, exploit momentum when it comes up, or have a quality overlay in the evaluation process. So therefore, if you want to exploit a pure momentum strategy, you have to have a momentum smart beta in your portfolio to diversify your overall portfolio. So therefore, again, purely from that portfolio construction perspective, if you want to build robust solutions through time, it's really a combination of smart betas and active fundamental managers in a blend.
The $1,000,000 question that I'm sure you get asked in all your interviews, performance. So in my naive world, you've got passive investments, which kind of give you the middle of average. Then you've got active investments where, I mean, dare I say it, if you've picked a good manager or a good blend of managers, you get outperformance. If you've picked badly, you get underperformance. Where does smart beta fit from a kind of performance profile point of view?
And Natalie, it's similar. So, I mean, we need to understand that the market is constructed such that certain fundamental factors work at a specific point in time in the market, and at some points it doesn't work, right? But through time, you should expect that certain fundamental factors will drive the market's performance and therefore outperformance over time. Okay, so let's for example look at a value kind of an approach, and if we go back in time a couple of years ago. And for a long period of time, it's in excess of 7 years, value as a strategy underperformed the market quite significantly. And therefore, active managers following a valuation kind of approach would have underperformed the market, accordingly. So therefore, I mean, often we say that that's not a good active manager because they've underperformed the market considerably, but it's not necessarily the case. We should look at what that opportunity set is, how the market has actually rewarded that specific strategy, and measure the performance according to that kind of a metric. Right. So in a similar way, therefore, that active managers can underperform for a significant amount of time, which is not necessarily a reflection of skill. So can smart betas as well. It's really about understanding the diversification that different risk premiums can offer you in the market out there, because all of them won't underperform necessarily at the same time. So, often what we see is that value does underperform where momentum does better. So it's getting that blend of those strategies together in a portfolio context to deliver the more robust returns. But yes, they can go through cycles of underperformance and outperformance as well.
So disappointing to hear that there's no silver bullet for my apparently severely underfunded pension fund while supporting 2 children through university. Having said that, I think where my mind goes when we talk like this, and when I listen to the way you're explaining this to me, my mind goes to multi-managers. And so when we start talking about blending and we start talking about kind of making calls of underlying philosophies or strategies, my mind equates that to multi-management. Very, very quickly and simplistically, what is the difference between multi-management and smart beta when it comes to a strategy selection point of view? So not the technical differences between the two, but why would trustees pick smart beta over multi-management, for example, or the other way around?
Sure. So when it's for me, it's about, and for us, it's about the combination of those premiums, right? So if you're going to select purely just one smart beta portfolio, you're going to sit with the same kind of an issue that a single asset manager or fundamental manager sits with, cyclically underperform and outperform. But if you can combine those different strategies with the knowledge of understanding what kind of different market cycles they benefit from in a specific way, you can get a lot more diverse and robust outcomes through time. So it's in concept similar to a multi-manager approach, but it's a multi-strategy approach. So it's similar to an active fundamental manager that does not hang his hat on one specific fundamental or philosophical approach of value, but they'll adopt as the market changes. And at times they'll follow more of a valuation approach, and at times they'll take advantage of certain trends and therefore shift their portfolio more into a momentum approach. So it's really that multi-strategy effect that drives robustness in the outcomes. But in concept, it's similar to a multi-manager kind of approach, just on a strategy and on a risk premium level.
Interesting. And to close up on the fees conversation, much like we've looked at the performance between the three, the fees of a smart beta, if I was comparing a smart beta portfolio to a balanced multi-managed portfolio?
So on the institutional side, I mean, I would say it can be as little as half of what active fundamental managers charge. So for a typical smart beta with scale, again on the institutional side, I mean, it can range anything from, if you negotiate quite well, from 15 odd basis points to 25 odd basis points, to getting access to those smart beta strategies. Whereas we know where active fundamental strategies typically sit. So it is somewhere in between your pure passive and your active strategies.
So definitely worth looking at for trustees of retirement funds, management committees in umbrella funds. Smart beta is something that we should be talking about and considering. Thank you. Thanks, Eugene, for taking the time to explain this to me today. I look forward
Thanks,
to our
Natalie.
next chat.
Perfect. Thank you very much.